very warm welcome to everyone who has joined us today from across the world. My name is Deepa Thakkar and I manage NRI products for HSBC India. I will be your host for the evening and I am delighted to welcome you today to our special initiative, Life Beyond Borders. While HSBC India is continuously working towards making your financial journey better, we have been taking customer feedback on what more value can we add to their lives. To bring beyond banking to our customers and stay engaged with you, we have launched a specially curated series of Life Beyond Borders. We have received an overwhelming response for the series and have 1,000 plus clients joining us every month from across the world. Our last month's webinar was in partnership with our partner, India Assets, where we discussed how India Assets can provide specialized solutions for remotely managing your real estate assets, be it buying, selling, or renting out properties in India. Today's webinar is on decoding taxations for our NRI clients. There are a lot of investment avenues that are available in India, and there is a lot of interest from you to invest in India, given the higher returns. Once you start investing in India, all incomes become subject to tax deducted at source. Although income earned abroad is not taxable in India, non-resident Indians have to pay tax in India on capital gains from shares, mutual funds, and term deposits if it exceeds the basic exemptions. To help us understand and decode taxation for NRIs in India, I am pleased to welcome Saikat Roy, Manager, Direct Tax and with our partner ClearTax. Saikat is working with ClearTax from the last 4 years and leads the internal tax for the team in Clear. He is an expert on international taxation and has prior experience of working with the big fours in this field. A very warm welcome, Saikat. Thank you for joining and taking out time today to provide expert advice to our NRI clients and cover critical topics of income tax, wealth tax, and property tax in India. Audience, please do keep sharing your questions in comments and I will take it up with Saikat. I will try and answer as many questions as we can. Without further ado, welcoming Saikat to talk to us on NRI taxation in India.
Thank you, Deepa. Thank you so very much for this wonderful introduction. I could not have put that better myself, even if I tried. And I really thank you all on behalf of Clear for having us and having a little bit of our knowledge, our experience with your clientele. Now, my name is Saikat Roy, and I have, like Deepa said, have been part of Clear for last 4.5 years. In Clear, we are trying to make financial life as simple as possible for Indians. Now, Indians, they will obviously include NRIs because you can take an person out of India, but you cannot take India out of a person. Therefore, wherever you are always Indian, and we are thriving to make your financial lives better as well. So if you have any question regarding taxation, as you know, the tax season is going on in India. So if you have any question, we are here to answer those questions, and hopefully we will be able to make your lives a little bit better and worry-free. So can we get to the questions, Deepa?
Thank you, Saikat. And we are extremely delighted to announce ClearTax as our partner and helping our NRI clients to file their taxes here in India. 31st July is the deadline for individual tax filing. We have started receiving a few questions, Saikat. So the first question that it goes is that basic question that who is considered as non-resident in India? For people who have just relocated, they want to understand when they can be qualified as non-resident Indians.
Okay. Now, the question that was raised, Deepa, that's a very important question because at the heart of every taxability, the concept of residential status, rather tax residential status, is most important question to be answered, because based on the tax residential status, it is determined whether in India they will be paying taxes on Indian income or global income. In normal parlance, if a person is staying in India for a period of 182 days or more, that person becomes a tax resident in India. However, there is another point which actually says if a person is in India in the last financial year, and his stay is total 60 days, and he has stayed in total of 365 days in 4 financial year preceding to the concerned financial year, that person becomes a tax resident of India. Now, most of the people who are going out of India may feel that I am going out of India. In that case, 60 days criteria will kick in and I will become a tax resident. However, if one person is going out of India for employment purposes, in that case, 60 days criteria, 60 days plus 365 days criteria will be ignored, you can say. Because if you are going out of India for employment purposes, in that case, we only need to see whether you stayed in India for 182 days or more in the concerned financial year. If you stayed in India for that much period, you will become a tax resident of India. If you stayed lesser than that, you will become a tax non-resident in India. Now, if you are a tax non-resident in India, in that case, only Indian sourced income will be taxed in India. If you are a tax resident of India, in that case, your global income will be taxed in India. However, if you have paid any taxes outside India, that amount of tax you can claim as credit, foreign tax credit in Indian income tax return. You have to file a one specific form number 67 to claim that refund, and you need to attach proof that you have actually paid taxes outside India. So there are certain more complication if you are a tax resident and earn some foreign income and paid taxes as well. But this is something we at ClearTax made simple. So if you are inputting the data in the system correctly, those data will be parsed, those data will be captured and filed. Only thing is that you have to file form 67 right now in income tax portal, but we are working closely with income tax department so that you can file clear form 67 from our platform as well. And if you are a little bit concerned or confused about how to go about it, in that case, we at Clear have an expert team who can file your income tax return.
Thank you. So that was quite elaborative and you covered all the scenarios. Thank you, Saikat. The next question states that when is an NRI required to pay tax in India? And if they earn foreign income, is that taxable in India as well?
Well, firstly, we have to say that we are assuming that person has gone out of India for employment purposes and stayed less than 182 days in India, say 170 days, right? In that case, only Indian income will be taxed in India. Any foreign income will not be taxed in India, as simple as that, right? So some FD incomes might be there, some dividend income might be there. Maybe he is going out of India for secondment purposes, right? So for that period he was there in India, that part will be taxed in India. Remaining part, if that person is going, say, in UK or USA, whatever it may be, the foreign income foreign income will be taxed in that specific country. And if that person becomes a tax resident of that country in UK or USA, in that case, global income will be taxed in that country, the host country. And whatever the tax that person has paid in India, he can be able to claim the tax credit by following that country's Income Tax Act and rules.
Understood. Saikat, the next question is on the mariners, because we have many of our clients who are, mariners, and they are off land for 6 months period. So what is the definition for mariners? Is it different for them? And is it different if they are on Indian ships and foreign ships?
Well, mariners as such in Income Tax Act, there is nothing conclusive about who are the mariners. In Income Tax Act, while talking about residential status, tax residential status, it has been said that crew of a ship, right? Now, the distinction or the confusion between Indian ship and the foreign ship, that actually occurs because of how India has been defined in the Income Tax Act. Right. As per Indian Income Tax Act, India actually includes the territorial water, the seabed, the airspace, etc., etc. It has nothing about Indian ships. So in the olden days, what might have happened is, since Indian ships were not included in the definition of India, people used to, the income tax official, they used to, club the income, consider the income of Indian ships, considering them a part of India. So, and if a person is going in a foreign vessel, foreign ship, then only 182 days criteria would have been seen, and that person would have fallen out of Indian tax residency. Now, to negate this situation, the CBDT, they firstly issued a clarification, and later point of time, they have embedded this in the act itself. If you are a member of crew in an Indian ship and you are going out of India, in that case, you have to stay in India for a period of 182 days. Then only you will become a tax resident of India. In foreign ship, obviously, if you are going out and you are stay outside India, or rather your stay in India is less than 182 days, you will become a tax non-resident. And again, only Indian sourced income will be taxed in India. As simple as that. So this was a confusion that was going on for quite a long while, and it has been, set in stone through the act itself right now.
Verified. Good, good, good. Because we have many of our clients who are mariners, and we have a special segment for mariners. So that's why these questions are coming. The next question is that what do you mean by earned in India when you are filing taxes? By the term earned in India.
Got it. So earned in India means any income that you have received in India. Firstly, we have to understand there are two concepts. One is accrual and one is receiving, earning. Now, accrual means if you are getting the right to receive a particular income, right? Say, for example, you are providing a service to one of the organization, right? Now, you are not doing it for charity, right? You are doing it for money. So if you have provided service to an organization, you are going to get the right to receive money from that organization. Now, this right to receive money is accrual, right? You are supposed to get that money. That means it is accrual. But once you get the money, actually receive the money is landed in your bank account. In that case, it is to be said that money has been received or earned in India.
Understood. So, so the next question was accrued in India. So you already covered that as well. Now there are questions on deductions, because all of us, as resident Indians do get deductions, tax deductions when we file our income tax return. Are NRIs having any such provisions under Section 80C, 80T or 80G?
Well, absolutely. So for NRIs, non-resident Indians, there are certain restriction in Section 80C. For example, PPF, they can contribute in PPF, but they will not be able to take the deduction of PPF. But rest of the other things are quite open. Also, under normal circumstances, children education fee, if they are attending any school, college or university, that amount of fees is deductible. However, for non-resident, I can presume that their children are attending any foreign school. Those fees cannot be taken under 80C. However, rest of the other items, say for example, life insurance policy, say for example, ELSS mutual fund. So those deductions are still available for non-resident Indians. And talking about 80D, yes, for 80D, there are certain restrictions for non-residents. So if you are a senior citizen who are staying outside India, you are a non-resident. In that case, we know there are two limits of medical insurance premium, right? One is 25,000 rupees. One is 50,000 rupees for senior citizen. Now, if you are a non-resident, this 50,000 rupees will not be available for you, right? So let's take a scenario wherein you are a non-resident and you are a senior citizen. So, and you are paying, let's say, 70,000 rupees of medical insurance premium in India. In that case, you will be able to take maximum of 25,000 rupees as deduction. Now, let's take a reverse scenario. You are an Indian tax resident. Your parents are non-tax resident, right? You will be able to claim 25,000 rupees for your medical insurance. You will be able to claim 25,000 rupees for your parents. You will not be able to claim 50,000 rupees for your parents just because they are senior citizens. So again, another situation that might be, and that thing will be more prevalent. So you are a non-resident Indian, your parents are in India and they are resident. In that case, for you, if you are paying any medical insurance premium in India, 25,000 rupees, up to 25,000 rupees you can claim. For your parents who are staying in India, they are tax resident of India, you can claim 50,000 rupees. And talking about ATG, that is charitable donations and everything. In that case, yes, you can certainly make the donation. There is no problem whatsoever. But depending on the charity, whether it is a religious organization or proper charitable organization, you can claim maximum up to 50% of the amount that you have donated. If you have donated in any PM Cares Fund or Soldiers Fund, that sort of thing, then 100% of the donation is deductible. But if you are making the donation in charitable or religious trust, in that case, maximum 50% of the donation amount you can claim in your tax return.
Understood. So basically, they are eligible for many deductions similar to what we are.
That is correct. There are certain little restriction, but
Yes.
they are eligible to claim it.
Okay. And the next question goes, what are income tax rules for income from investments and long-term capital gains for NRIs? That is section 115E.
Right. So section 115E actually is talking about if you are making investment in Indian companies, Indian listed companies through foreign exchanges, right? So maybe you have earned certain dollars and you are looking to make this investment in India. Now, you can do that. You can do that in foreign exchange. Then only section 115E will get triggered. Now, if you are going with section 115E, the long-term capital gains is taxed at the rate of 10% on the asset. And if you are getting any other sources of income, say for example, you are getting some dividend or interest, right? In that case, the rate of tax is 20%. Now, there is a little bit of benefit over here in terms of this interest and dividend, because normally they are taxed at your slab rate. By any chance, if your income is more than 10 lakh rupees, if you are opting under the old tax regime, in that case, the marginal amount, which is beyond 10 lakh rupees, that will be taxed at the rate of 30%. Now, if your income is not crossing 10 lakh rupees, there is no special benefit for you under any of these sections. But if your income is more than 10 lakh rupees and opting under the old tax regime, there can be a little bit of benefit available for you under 115E. Now, couple of things you should be keeping in mind. This 115E is available for non-resident Indians, right? So if you are not a non-resident Indian, if you're simply a non-resident, you will not be able to claim it. But since our target audience are NRIs, hopefully most of them, or if not all of them, they will be able to claim it.
Understood. So the next question is on 115H. What are the provisions on that? So E we covered. Is it H is different from E?
See, 115H is actually talking about once you become a tax resident in India from a tax non-resident in India, right? In this case, you may have to submit a declaration, or rather you need to submit a declaration at the time of filing your income tax return to your assessing officer. That can be done through income tax return actually. Stating that you still chose to be taxed under the special tax provision, that is 115E, 115A, all those things. And those special provision and special rate of taxation will continue to be applicable for you. This is actually 115H. Now, 115H, if you read it separately, you will be confused. You need to actually link with other section 115A, E, etc., etc. right? So that is it actually. So if you become
So
a
it's
tax
basically for
resident in
returning NRIs who are returning back?
yes, 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 yes. However, one point I would like to make right now, if you are a non-resident, then you can choose to be taxed under the normal provision of income tax as well. There is nothing stopping you, right? However, in certain scenarios, in fact, in certain scenarios, normal provision of taxation might be beneficial for you. In certain limited cases, the special provision will be beneficial for you.
Like, can you tell us some instances?
Yes, like I said, dividend, right? Dividend or interest. So special rate of tax for dividend is 20%, right? Now, under the normal provision, if you have, let's say, income of more than 10 lakh rupees, the marginal amount will be taxed in the hand at the rate of 30%. But if you are opting for special provision, it will be taxed at the rate of 20%. So now there needs to be a cost benefit analysis whether your entire income, this dividend income, interest income, is crossing 10 lakh rupees or not. If it is crossing 10 lakh rupees, then flat 20% rate of taxes will be applicable on the interest income, right? But if it is not crossing 20%, 10 lakh rupees, then any which way, you will get the tax benefit, the benefit of 20% tax rate under the old regime, any which way. So therefore, I said, in certain specific scenarios, the special provision of taxes becomes attractive for you. Otherwise, normal provisions are much more, in line.
Understood. Yeah, this really helps. The next question is on what is foreign tax credit and how can I be eligible for the same?
Right. Okay. Now, foreign tax credit is applicable for the tax resident of India. That too, if that person is resident and ordinary resident. Now, let me paint a picture. Say, for example, you went outside India for 8 months, right? You come back to India. In USA, maybe in USA you went. From USA, you are getting some amount of salary. But unfortunately, you become a tax resident of India in the year of return. In that case, your global income will be taxed in India. However, since the source of that salary was USA, US tax authority, the IRA, they may have claimed a certain amount of taxes on that specific salary. Your US employer may have deducted a certain amount of taxes from that salary as well. Now, there is a principle in the tax act all over the India. You cannot be taxed twice on one singular income. Since you have paid taxes in India and you are offering that same income in Indian income tax return as well, Indian tax authority will not collect the amount of taxes that you have paid in USA. There is a treaty between India and USA. So with almost 90 countries, India has this DTAA, that is double tax avoidance agreement. By the virtue of it, if you have paid taxes outside India, those tax credit will be made available to you at the time of you filing the income tax return, provided you are fulfilling certain conditions. Right, you have to file form number 67 within the end of the assessment year. Right, in your income tax return, you need to, or rather, in form 67, you need to submit the proof that yes, indeed, you have paid certain amount of taxes. You have to calculate the FTC. So there is a lot of calculation that goes on at the time of the FTC calculation, foreign tax credit calculation. So if you are fulfilling these conditions, then certainly you will be able to claim. For non-resident Indians, if you are a truly hardcore non-resident Indian, in that case, FTC in India, FTC will not be available for you. It will be available for you in the country of your tax residence. Whatever amount of tax you have paid in India, that amount of tax credit you will get in the country of your tax residence. So this is how the FTC actually works.
Got it. And for country specific, maybe they can reach out to their CA or to Clear and get the
Definitely,
clarity.
definitely.
Yeah.
Just one quick point I would like to mention. In Canada and USA, there are two types of taxation that goes on. One is state taxation, one is federal taxation, right? Now, if you are coming back to India, you are being tax resident of India, the federal taxation will only be considered for FTC calculation purposes. State taxation or any other taxation, they will not be considered for FTC calculation. So please keep that thing in mind.
Understood. Yeah, we have many of our clients based in Canada, so this clarity helps. Second, on the next question, which ITR should the NRIs file? And while we cover the deductions, are there any exemptions to income tax also which are different from the deductions?
Right, yes. So for non-resident, ITR 1 cannot be filed. Right. So they have to go with either ITR 2 or ITR 3, depending on the nature of their business. Nature of their income, my bad. Now, they may be having, some dividend income, some interest income, small capital gains, ITR 2 will be there, right? They may have some small business income, maybe they are doing some consultancy, in that case, ITR 3 will be filed, right? However, they cannot file ITR 1 or ITR 4. These two forms are specifically designed for tax resident. So ITR 2 or ITR 3 form needs to be filed for non-resident Indians depending on their heads of income. And a couple of restrictions placed for non-residents. Firstly, in case of capital gains, right? In case of capital gains, for resident, if there is any unused basic exemption limit left, they can offset that with capital gains, right? Say, for example, I'm a tax resident of India, right? I have sold some shares, India listed shares, right? I have got a gain of, let's say, 3 lakh rupees. So under 112A, 1 lakh will be reduced. So it will be, my taxable capital gains will be 2 lakh rupees. Now, all the other sources of income combined, it is coming to 2 lakh rupees. My basic exemption limit is 2.5 lakh rupees. So there is a 50,000 rupees of unused basic exemption limit. This 50,000 rupees I will be able to reduce from my long-term capital gains of 2 lakh rupees. So my total taxable gain will be 1.5 lakh rupees. Now, this benefit is not available for non-resident. All right. So even if there are other sources of income is not crossing basic exemption limit, the unused portion of basic exemption limit, they cannot use it to offset capital gains. So this is one restriction placed on the non-residents.
Understood. Second, the next question is on how can an NRI apply for lower or nil TDS certificate in India?
Okay, that's a very, very good question, right? So many of the times NRIs face a huge, TDS at the time of, maybe they are getting rent, they have some house property in India, they are letting it out, or they are getting some dividend income, some interest income, etc., etc. So, so at that point of time, they can actually get a huge amount of TDS. Now, to combat this, they have to apply for 197 certificate to the assessing officer, right? So at that time when they were in India, they may have applied for PAN, or rather they have applied for PAN. They have to track down that assessing officer, make an application for 197 lower TDS certificate or nil TDS certificate. Now at the time of filing this certificate, they have to substantiate that their income warrants a lesser TDS or nil TDS. They may have to submit a draft income tax computation as well. Now, based on that application, based on that tax computation, the assessing officer will issue a lower TDS certificate, and those certificates will be made available to all the persons who are providing them with income. Now, based on that LDC, lower deduction certificate, the payer of the amount, they will deduct a lesser amount of taxes. So firstly, they have to approach the assessing officer. They may do it on their own. They may appoint someone to approach the assessing officer. They have to submit the tax computation and make the application. And based on that, they will be given this LTC.
Understood. So yeah, many of our NRI clients would not be aware of this. So good that we've brought this up. The next question is on property, which all of us know that NRIs love property buying and selling here in India because of the returns that we give. So what is the tax implication, or how much tax are they supposed to pay when they sell a property in India?
Right. Excuse me. So for property, for capital gains, one of the most important thing is the holding period of that asset. Right. For property, if the property is held for a period in excess of 24 months, they will become a long-term asset. And upon selling that long-term asset, long-term capital gains arises. Now, the rate of tax on that long-term capital gains is 20%. However, there are certain conditions that we need to consider. Number one, the cost of acquisition. At the time of computing the capital gains, cost of acquisition, the purchase price need to be determined. Right. Firstly, since those asset was purchased way back, I'm assuming more than 24 months back, right? Maybe 2010 they have purchased a flat, now they are selling it off. In that case, they may have paid a lesser amount as compared to today's standard to acquire that flat. For that, indexation needs to be done. So every year, CBDT, Central Board of Direct Taxes, they issue the index point. Now, based on that index points, they need to, increase the value of that property, the cost of acquisition of the property, and that needs to be reported in the income tax rate. Furthermore, the person may have done some sort of renovation or some sort of improvement in that property. So that can also be taken as indexed cost of improvement, right? So that can also be reduced. However, one point to be noted, if you are purchasing any furniture, maybe some sofa or some table like that, they are not to be deducted. But if you are doing some flooring work, some painting, right, some wiring, in those cases, those costs can be taken as cost of improvement, and you will be able to reduce that cost as well. One practical problem many people face, that when they inherit a property, right? We can see in a lot of the cases, people are inheriting the property. And most of the cases, the inherited property was purchased beyond 1/4/2001, 1st of April 2001. Now, in that case, indexation points are generally issued from 1/4/2001 itself, 1st of April 2001. Now, to get to know about the value of this property, the person who is selling of this property need to appoint a registered valuer who can value that property based on the income tax rule on 1/4/2001. Now, this is a very, very crucial step at the time if you are making the sale, because without that valuation report, your capital gains calculation may not be done correctly. So if you are inheriting a property, if you are selling off a property, and the property in reality was purchased before 1st of April 2001, it's a very good practice to appoint a registered valuer, get the valuation of that property done as on 1/4/2001, and from there onwards, you will be able to, index the property, uplift the cost of the property, and arrive at correct capital gains and pay the taxes. Or if you are looking to save some taxes, you can purchase another flat to save some amount of taxes. You can invest in 54EC bonds again to save some taxes. So if you are looking for some assistance in that, in filing the income tax return, of course, you can contact with us. We would be more than happy to help you out.
Understood. So yeah, I think this is one of the biggest topic. I think we've got multiple questions on real estate. So I hope Saikat has clarified most of it. The next question is on provisions of advance tax for NRIs. What are the provisions for advance tax?
Well, if your tax liability for the year is more than 10,000 rupees after adjusting all the TDS and TCSs, if the tax liability is more than 10,000 rupees, in that case, you are supposed to pay advance taxes in 4 quarters, right? So 15th of June, 15th of September, 15th of December, and 15th of March. These are the 4 dates you need to pay advance taxes. The rate of percentage of tax you need to pay in each of this quarter is 15%, 45%, 75%, and 100%, right? That is the provision. Now, if you are not meeting this condition, there are 2 sections for which you may have to pay interest. That is 234B and 234C, right? So if you are not making the advance tax payment, then whatever amount of shortfall you are getting on that, 1% of interest per month will be charged on that shortfall. So that's a very good topic you raised, Deepa, because many of the people don't really know about advanced taxes. They may sell shares, they may get certain incomes, etc., and they may miss the deadline. However, one thing that is there, that is saving grace for non-resident, that is they get a huge amount of TDS, right? The companies, whenever they are issuing dividend or interest, they deduct a hefty amount of TDS. Now, by the virtue of that huge amount of TDS, they may sometime escape from the penal provision of not paying advance taxes. But it's a very, very good practice if you have a good amount of interest, investment, income, dividend coming from these organizations, and pay some amount of advance taxes so that you can file your income tax return very peacefully.
Yes. So yeah, because many of our clients are, under the global mobility, they are salaried in India and now they've moved outside. So normally for salaried customers, advance tax gets cut by the company itself in India. So they may not be aware of these dates. So, the customers, hope you've noted down these dates so that, you don't miss out on the advance tax filing. The next question is on what is the deadline for personal income tax filing for this year and how can ClearTax help them in filing these returns?
All right. So the due date as it stands is 31st of July 2023 for filing the income tax return of financial year 22-23, right? So do not miss that date, right? There are very good reasons why I'm saying this, or rather emphasizing the fact, do not miss the due date. Now, there are certain situations wherein you can suffer a loss. Say, for example, you are actively participating in stock exchanges, right? But during the year, due to some unforeseen events, you made a loss, right? Say, for example, you made a short-term capital loss. Let's say it is coming to 10 lakh rupees. If you are not filing the income tax return within the due date, that is 31st of July, you will not be able to carry forward this loss in future years. Now, carrying forward of this loss in future year is very, very important. Why? Because in the upcoming year, if you make a short-term capital gains, this carry forward loss can reduce that year's capital gains and you could pay a lesser amount of taxes. So filing the income tax return to carry forward the loss is very, very important. If you are not filing your income tax return within the due date, the loss cannot be carried forward. So do not miss out this date, 31st of July 2023. Now, if there is no loss present, you can still choose to file an income tax return a later. In that case, certain interest as well as some penalty will be levied upon you. But just to carry forward the loss, you should be filing your income tax return within the due date, and it's a very good practice to file your income tax return. Now, in ClearTax, we have made this tax filing journey very simple. Now, if you are investing in shares of Indian entities, right, you may be using some of the brokers. Now, most of the new age brokers, they provide some capital tax P&L statement. Excuse me. Now, that tax P&L statement, our software can read automatically. So you don't really have to input the data manually. You can simply upload that capital gain statement, the tax P&L statement, whatever it may be, and all the data will be picked correctly. It will be replicated correctly in the income tax return, and tax computation will be provided to you flawlessly. So this is how we can help you to file your income tax return. Not only that, you are not supposed to choose your income tax return form. Based on the data that you are inputting, the proper form will be selected automatically. Your regimes will be selected automatically. And again, if you are having some trouble navigating through the complex laws of Indian Income Tax Act, then we have our dedicated team of experts who can actually help you file your income tax return. So either way, we are happy to hear from you. We are happy to help you out in this entire scenario wherein you can trust us to file your income tax return. We will be more than happy to do it.
Great. There are now some specific questions to some specific clients. Like one client is asking that if there is an accrued interest of FD and the tax is paid in India, and now he is based in UK, can he claim that tax from the UK tax authorities?
Yes, absolutely. So he has to first pay taxes in India, and UK actually follows the financial year similar to ours. So in UK, I think 6th of April to 5th of April is the tax date. So yes, at the time of filing your income tax return, you can certainly claim the tax that you have paid on that interest accrual, but you have to see what type of tax regime you were selecting there in UK. So there are 2-3 types of tax regimes prevalent in UK. So talk to a CA in UK and he will be able to guide you better.
Okay. The next question is again of a UK resident. She's asking that what type of taxes she needs to pay in UK and India both, especially if there is a term deposit, interest on term deposit, mutual fund capital gains and dividends. Does she have to pay tax both in India and UK or not?
See, firstly, we have to determine in which country she is becoming a tax resident of, right? Okay. I'm assuming that that person is becoming a tax resident in India, right? We are focusing on India. If she is becoming a tax resident of India, then she may have paid certain amount of taxes through PAYE in UK. Now, in India, whatever Indian income has arisen, that amount of taxes India will be claiming, no doubt about it. Whatever amount of salary that person has received from UK, that will also be claimed by India. However, any amount of pay she has paid in UK, that amount she can take as relief in Indian income tax return. Now, in the reverse scenario, she becomes a tax resident of UK. In that case, HMRC will take the entire global income and collect the taxes on it, and India will be collecting whatever taxes is there on Indian sourced income. Now, HMRC, they will give relief for Indian tax paid, and she will be able to claim FTC in UK in this scenario.
Understood. There is a NRI who has bought a property in Dubai and is a tax resident of USA. Is there anything that the person has to keep in mind in the long term in terms of returns perspective?
Right now, there is nothing to be done. All right, there is nothing to be done. But if that person becomes tax resident in India, then he may face certain question regarding some foreign asset. Now, since this person is from USA and they have earned certain income, obviously they have paid taxes in USA as well. So he will be able to substantiate that, yes, whatever amount of property, whatever property they have purchased that was used, whatever amount they have earned while they were a non-resident in India. Therefore, India does not have any taxing right. For these purposes, he may have to submit copy of passport to Indian tax authorities and answer certain questions, give some clarification, and the query would be over at that point of time.
Understood. The next question is that please can you cover tax deducted by property buyer on the sale amount and process and the complications to settle it with the IT department?
Okay.
So if I have sold a property,
if someone is selling off a property, in that case, under 194 IA, capital A, the buyer is supposed to deduct 1% of the value of that property as taxes. Now, this amount of taxes can be claimed as TDS, but filing of the income tax return needs to be done. Now, here I would like to mention one thing, that is, if you are not filing your income tax return, the TDS claim cannot be claim of TDS cannot be claimed. Secondly, we have to ensure when the property was purchased. If it is purchased after 1st of April 2001, there is nothing to be worried about. So you may have your purchase date, you may have your sale date. Based on that, you can file your income tax return. You may also deduct some cost of improvement as well, the painting charges, flooring charges, etc., etc. For that, the bill and the bank statement should be sufficient enough. Now, based on this fact, based on this figure, you can file your income tax return and claim the TDS that was deducted by the tax that was deducted by the buyer of that property.
Got it. Got it. So the next question is that if a NRI's income from Indian sources is less than the minimum threshold of taxation, are they exempt from filing annual tax returns, or they still have to file the return at least?
Right. So if your income is no more than 2.5 lakh rupees, in that case, Indian income is no more than 2.5 lakh rupees, you are exempted from filing the income tax return. There is nothing. However, we can see that many people who have, let's say, 2 lakh rupees, 2,30,000 rupees of income, the banks, while giving out this income, they deduct taxes at a very high rate, right? Maybe 20%. Right. So on giving you 2,30,000 rupees, bank will be deducting 46,000 rupees. You can claim this amount as tax refund, and that can only happen if you file your income tax return. So yes, you are free from not filing income tax return. You are absolutely do so. But by not filing your income tax return, you will be foregoing a certain amount of refund. So if you are okay with it, then the income tax department is also okay with it. But if you are not okay, if you want to claim that refund, then yes, by all means, you have to file the income tax return.
Okay. So now there are some NRIs who are asking about capital gain tax bonds. How can they buy, where they can buy, and where to sell after maturity in case of, saving tax after sale of property?
So capital gains bond, I believe they are talking about section 54 EC bonds. Now, 54 EC bonds are available in the banks, nationalized banks. So so in case you want to purchase those bonds, there are certain organizations, they issue these bonds, right? So NHAI, that is National Highway Authority of India, RECL, Rural Electrification REC Corporation Limited, right? Power Finance Corporation and Railway Finance Corporation. These are the 4 bonds which comes under the ambit of section 54 EC bonds. Now, you can approach banks to purchase these type of bonds so that you can save the taxes. Now, please make sure you are selling off a property, then only you will be able to claim 54 EC bonds benefit. Secondly, you need to purchase these bonds within a period of 6 months, right, from the date of transfer of that property. If you are, purchasing them after 6 months, in that case, you will not be able to claim the deduction. If you are purchasing within 6 months, then yes, of course, you can claim the deduction. And maximum amount you can save purchasing this bond is 50 lakh rupees. So if your capital gains is, let's say 30,000 rupees, you will be able to, 30 lakh rupees, you are required to purchase 30 lakh rupees of bonds, so that you are not supposed to pay any taxes. If it is, let's say, coming to 70 lakh rupees, maximum amount you can save is 50 lakh rupees. On remaining 20 lakh rupees, you will be required to pay the taxes.
Understood. There are quite a few questions. I'm trying to squeeze in as many as possible. We have 10 minutes to go. The next question is, are there any taxes applicable for transferring money from my NRO account to overseas? And is there any limit for these transfers?
See, the limit for transferring the money from NRO account to outside India is 5 lakh US dollars, right? So we only have the US dollar limit. So if you are sending money in any other, currency, right?
Convert it to that amount.
So that will be the US dollar amount, we can say, because in the law they mentioned US dollar, 500,000 US dollar. So you may have to do a little bit of calculation on your own. All right. And as such, there is no charges of taxes when you are sending money outside India. If you have paid taxes on the income that has already deposited in NRO, then there is no requirement of paying the taxes on that amount in India. However, there are a couple of compliances you have to follow. First of all, there are two forms that need to be submitted. One is 15CA, one is 15CB. Now, 15CA is a form that you need to submit to the bank, right? And 15CB is actually a certificate issued by a practicing chartered accountant, wherein it is certified that whatever amount of due tax is there on that amount that you are sending outside India has been duly paid, and this amount is free to transfer. So these two certificates you need to submit. These two are the compliances.
Got it. The next question is Aadhar card mandatory for filing taxes? If they don't have Aadhar card, how will they file taxes?
See, relaxation has been extended to non-residents. So if you are a non-resident, you are not supposed to quote your Aadhar number in the income tax return.
Okay. And how do they get back the TDS money from NRI and NRO accounts?
See, the money will be landing in their NRO account, right? So there is this specific purpose of NRI account and NRO account. In NRO account, any amount that is originating from India is deposited. Any amount that you are sending out in India, that will be landing in NRI account. Now, if you are sending money, tax refund money from NRO account to outside India, in that case, 15CA and CB needs to be filed. And upon filing that, you will be able to send that money out.
Understood. The next question is, what is Form 26AS?
Okay. Now, Form 26AS is a form which depicts your earning on which tax has been deducted by the payer, right? Now, over there in 26AS, you will see if you have, any FD income, FD interest income, and on that certain amount of tax that has been deducted, it will be there. So 26A's in summary form is a tax credit statement. It actually lists out what is the amount of tax credit you are going to get during the year. However, at the time of filing, not only you need to see 26A's, then there is another form that you need to refer to, that is Form AIS, Annual Information Statement, right? Because in 26As, all the income against which tax has been deducted will be listed out. But in AIS, all the incomes that you accrued during the year will be listed out. So AIS is a little more comprehensive than 26As.
Understood. Quite a few questions on inheritance and tax relating that. So, if suppose your parents leave property or mutual funds investments for you, is there any tax that the NRIs have to pay before they can claim those
So
inheritance?
as of now, in India, there is no concept of inheritance tax. I believe it is there in USA, but in India, there is no concept of inheritance tax. Now, if your parents have you are inheriting some property or mutual fund units, whatever it may be, from your parents, then the cost of acquisition, that is one of the key amount to compute the capital gains. Cost of acquisition will be as the same amount as your parents at the time they bought it. So if your parents have bought share of, let's say, MRF for 100 rupees, now you are selling it off for, let's say, 1 lakh rupees. So cost of acquisition will be 100 rupees. Your capital gains will be 99,900 rupees. On that, you need to pay. However, since MRF shares are listed, grandfathering rules will be applicable under section 112A, wherein we need to compare the value of 31st of January 2018 to get at the correct cost of acquisition. So in short, upon inheritance, there is no tax as of yet in India.
Understood. The next question is on what are the tax slabs for NRI, someone who is a senior citizen, like a 75-year-old OCI tax resident?
So 75 years old, right?
Yes, 75 years.
So in that case, up to 3 lakh rupees, there is no taxes. From 3 to 5 lakh rupees, it is 5%. From 5 to 10 lakh rupees, 20%. And beyond 10 lakhs, it is 30%.
Understood. The next question is, we all know NRE deposits are tax-free. So do they have to show the NRE deposits in Schedule AL if income is less than 50 lakhs for resident but not ordinary resident?
See, Schedule A kicks in when your income is more than 50 lakh rupees. Your taxable income is more than 50 lakh rupees. If it is lesser than that, then Schedule AL will never be triggered in this case. So no, you don't really have to show.
Okay, that is good. That gives clarity. The next question is again on sale of property, capital gains. I think we've already covered that. And the next one is on a lot of questions on PAN and Aadhar linking. Since NRIs do not have Aadhar, how can they link their PAN and Aadhar? And if they don't have the Aadhar card, whom should they inform? Is there any particular form or any particular department whom they should inform?
See, again, non-residents are not required to, link their PAN and Aadhar because they do not have Aadhar.
Exactly.
Not only that, they are not supposed to quote Aadhar number in their income tax return. So, Indian government has given relaxation in terms of Aadhar quoting to non-resident Indians. So they don't really have to worry about it. But once they come back to India permanently, they become a resident of India. In that case, they need to get a Aadhar, and Aadhar needs to be linked with the PAN.
So there are a few more questions, Saikat, but in interest of time, what I will do is I'll send these across to Tanmay and you, and maybe you can review them. And so with this, we come to the end of today's session. Saikat, thank you for your time and valuable insights. I'm sure that our viewers have got some great takeaways from today's session. To our customers who have joined us today, I hope this was useful, and do keep tuned in for our future sessions. As you can see on the screen, there's a ticker going on with the mobile number and email ID. For any unanswered queries or any further queries you have, please write to the email ID, and the ClearTax team will respond to you. All the views provided in today's session are from ClearTax. HSBC is no tax expert, and these are not our views. We are also working on an exclusive offer with ClearTax and HSBC. So for HSBC clients, there will be an exclusive discount starting tomorrow. You will receive communication from us tomorrow regarding the same. For more details on that, you can also reach out to your RM. In case your topic was not covered, please do not hesitate to write to the email ID on the screen or to your RM. We will see you again soon for another interesting session. Have a great day and weekend ahead. Thank you very much.
Thank you all. Thank you all for joining with us. I hope you have taken certain insight of the tax and hope to see you soon.
Thank you.